Today, we're digging into a question that just about every serious investor asks at some point. How in the world do you get a piece of the action at the hottest companies before they go public? We're going to talk about how to get past that velvet rope of venture capital. Let's dive in. You've probably heard some version of this quote before, and listen, it's not just some cynical jab. It points to a really deep truth about how modern markets work. The idea is pretty simple, right? By the time a company finally hits the stock market, the insiders, we're talking the founders, the first employees, the big venture capital funds, they've already ridden the most explosive, life-changing wave of growth. You, the regular investor buying on day one, you're often just the person they're selling their shares to so they can cash out. And this isn't just a theory. Look at what happened with Airbnb. The insiders, the big Wall Street banks, they got to buy in at the offer price of $68 a share. But the second it went public, the very first trade a normal person could make was at $146. That's a 115% gain that happened in an instant, and you were completely locked out. Your first chance to get in was after the stock had already more than doubled.
So how did we get here? And more importantly, is there any way for the rest of us to get in on this? Well, in this explainer, we're going to walk through it. First, we'll break down what we call the IPO gap. Then we'll meet the gatekeepers and the bouncers game. After that, we'll see if we can find a way around them by finding a side door, explore a really wild new idea called the tokenization key, and finally, we have to face the brutal truth inside these exclusive clubs. All right, let's start with part one, the IPO gap. This is really the heart of the matter. It's the reason why getting in early has become the holy grail for so many investors. The biggest party, with all the crazy growth, is happening long before the doors ever open to the public. Just look at how the speed of business has completely changed. An average big company from a few decades ago might have taken 20 years to be worth $1 billion. And a lot of that growth happened while it was a public company you could invest in. But now, look at the modern tech giants. Google hit that mark in 8 years. Facebook did it in 6. And Uber, just 3 years. And all of that insane hockey stick growth happened behind closed doors while they were still private companies. And here's the real kicker. It's not just that they're growing faster. It's that they're staying private for way longer. I mean, there's so much private money floating around these days, they just don't need to go public to fund their growth anymore. And what that does is it locks almost everyone out of the single most profitable part of a company's life. The real generational wealth is being made before you or I ever get a chance to click buy. Okay, so if the real party is happening in the private markets, who's the bouncer at the door? Who's deciding who gets in and who stays out? Well, that brings us to part two. The bouncer's game. The bouncer has a name, and it's called the Accredited Investor Rule. Basically, in the U.S., securities laws say that if you want to invest in these high-risk but potentially high-reward private deals, you have to prove you can handle the loss. That generally means having either $1 million in investable assets, and that doesn't count your house, or making over $200,000 a year. Now, the idea was to protect regular folks from losing their shirts on risky startups, but it's also become the main gatekeeper to this entire world of wealth creation. And just how exclusive is this club? Well, according to Robinhood's CEO, these rules effectively shut the door on about 80% of the entire U.S. population. Think about that. The vast majority of people can only stand on the outside and watch as these private valuations go to the moon. So if you can't get past the main bouncer, is there a side door? Part 3 is all about the new ways that companies are reaching the public market, and more importantly, the new platforms that are trying to bypass that old exclusive system. So let's quickly break down the alternatives. You've got the traditional IPO, which we know is slow, expensive, and gives insiders that huge pop. Then there are SPACs. These are basically blank check companies that go public with a pile of cash and then go find a private company to merge with. It's a faster on-ramp to the public markets, but man, they've gotten a bad rap for not having enough scrutiny. And finally, you have direct listings. This is what companies like Spotify did. They don't raise new money, they just list their existing shares on an exchange so early investors and employees can start selling. But the really interesting side door, the one that's getting a lot of buzz, is the rise of these secondary markets. We're talking about platforms like Forge Global and Hive. They're creating a marketplace for shares of companies that are still private. So think about it. An early engineer at, say, Stripe might be sitting on millions in stock options, but it's all just paper wealth until an IPO. These platforms let that engineer sell some of their private shares to accredited investors who are dying to get in. It's basically an auction. You can go on Hive, see a block of shares for a top unicorn, and place a bid. It's a way for employees to get some cash now and for investors to get a foot in the door, sometimes years before a public offering. But what if you could just skip the bouncer and all the side doors entirely?
This brings us to the most radical and, frankly, controversial idea yet. A potential master key that's built on crypto technology. Part 4. The tokenization key. And a really fascinating experiment with some of the biggest names in tech today. So, how on earth does this work? Okay, step 1. A company like Robinhood takes its own investment in a private company, let's say SpaceX. Step 2. It creates a digital token on a blockchain. Now, this is crucial. This token is a derivative. You don't actually own a share of SpaceX. You own a token whose value is tied to Robinhood's stake. Step 3. Robinhood's users can then get these tokens, giving them a kind of synthetic exposure to SpaceX's private valuation. But, and this is a huge but, the token is totally locked. You can't sell it, you can't trade it, you can't do anything with it until some future event, like an IPO, happens. The vision, you have to admit, is pretty powerful. Robinhood's CEO pitched it as a way to finally give small investors a taste of the deals that were previously only really available to the ultra-wealthy. It's this idea of democratizing the most exclusive markets where all this modern wealth is being generated. It sounds pretty revolutionary, doesn't it? A master key to the most exclusive club in finance. But, getting into the party is one thing. Knowing what's actually going on inside is something else entirely. And that brings us to our final section. The brutal truth inside. Because this new kind of access, it comes with some really steep trade-offs. So let's just ask the question directly. You did it. You got your hands on a token that represents a piece of one of the hottest private companies on the planet. Awesome, but what do you actually know about the company? What rights do you have? What can you even do with this thing you supposedly own? Just think about all the basic stuff public companies are legally required to give you as a shareholder. Quarterly, audited financial reports, the right to vote on big company decisions, detailed commentary from the CEO explaining their performance. With these private tokens, you get, pretty much none of that. You have no idea what the revenue is, if they're making money, or if their balance sheet is a complete mess. You are, for all intents and purposes, flying completely blind. And to put a fine point on it, without that basic financial info, you have no real way to analyze what you bought. You can't figure out its true value, you can't track its performance. You're not investing based on fundamentals anymore. You're just speculating based on headlines and hoping for the best. And then there's the massive problem of liquidity, which is just your ability to sell what you own. And the difference here is literally night and day. You can sell a public stock in seconds, but with these private tokens, you are completely, totally locked in. The fine print is clear. You cannot sell it, you cannot transfer it until some unknown liquidity event way off in the future. That could be an IPO next year, or it could be never. Your money is just stuck. And the final risk is a doozy. The whole idea might not even be legal in the long run. The companies themselves are starting to push back. For example, OpenAI never authorized these tokens. In fact, they complained to regulators in Europe, and now that whole offering is under review. This is totally uncharted territory, and it could all get shut down at any moment, leaving anyone holding these tokens in total limbo. Which brings us right back to the central dilemma of all of this. Yes, the greatest growth today is happening in the private markets, but that access comes at a huge price. It happens in the dark with massive information gaps, no control over your investment, and your money locked up indefinitely. So the ultimate question every investor has to ask themselves is this: is getting early access to the party worth the price of flying completely blind?